a bounce back potentially, because we come from abysmal numbers. I think Steve was quoting numbers between -70 and -80% across the board for European car manufacturers and global ones. So there has to be a rebound from there as we gradually ease the lockdowns across the globe. Whether we will see demand back to the pre-crisis level, it might take more time. I think there was some good news yesterday on the news of maybe progressing towards a vaccine, but it might be a slightly slower recovery from that standpoint.
I want to get into the news flow because that news of the vaccine early stage trial certainly moved Wall Street. But against that narrative, we've also had increasing trade tensions between the US and China. What do you make of that as a deterrent for investors at some point? Because we saw what it did to sentiment on Wall Street when we had the trade war playing out. Do you think investors pick up on these negatives at some point?
They will. They have been relatively calm when it comes to those tensions. I mean, we're also getting used to those tensions to some extent. But this is something that's defining, I think it's maybe hard or a bit tough to say a new Cold War, but clearly a gradual rise of tensions, which will shape the way globalization is going to work. And as a result, probably may also dent optimism in terms of the strength of the recovery, the way we've been knowing it from a globalization standpoint. But there may be some positives out of that as well, but for the moment, this is not something that is being picked by the market. The market's more focused on finding a solution to the health crisis, knowing that we've got a bit of a backup from the central bank at this very moment. But it will come back very soon.
Antoine,
yes.
We clearly have free money across the globe as well. And when you have free money, those people who have their jobs, those people who haven't had huge trading losses, what have you, they will look to put that to work. And when you look to put it work in safe havens, you look at a high-priced gold. You look at a very high price with negative coupon or negative interest rate bonds in many cases as well. I think it's inevitable that the stock market is going to see a lot of that action as well. The question is, has it gone too far, or are our viewers right rather than wrong to be looking beyond the current events?
Well, the equity market is a discounting mechanism. So to some extent, we have to look beyond those events. Let's put it this way: there still is a lot of money sitting on cash at the moment. You're clearly right in saying that the opportunities for returns when it comes to safe assets is relatively low. I mean, we can question gold because it's different asset class. But where the money has been flowing so far this year is clearly into gold, not so much in bonds to some extent, or not so much into those kind of very low yielding safer havens. They've just gone to cash. The good news so far is that the cash levels have stopped growing. Now, are they? Is there a lot of cash in motion, fueling a fear of missing out type of trade? I don't think that is what we're seeing, at least from an ETF standpoint, and maybe from a broader custody standpoint from the State Street Group.